Todd, talk a little bit about active management, actively managed ETFs within fixed income, why they seem to be in demand at the moment. I mean, I do know the kind of conceptual advantages, of course, within a vast universe like fixed income, where you'd want to be able to do some credit selection.
Well, I think we're hearing it right now. You've got two of the leading fixed income ETF providers offering up some of the largest products, and they're able to balance the portfolio, shifting by taking on more duration or taking on more credit or less based on the environment that they're seeing. And investors are confused. It's okay that they're confused. We've got a market that has been volatile in both 2022 and in 2023. It's not clear how fast the Fed is going to slow down and how quickly that's going to adjust the marketplace. So they want to lean on the active managers to be able to do that. And we just now have more products that are out there. We haven't had this number of fixed income ETF products available from some of the leading firms that are here. Also Capital Group, Morgan Stanley. These are some of the firms that were quite visible at the Exchange ETF conference down in Florida that we were a part of. And now advisors and investors can tap into them to leverage that for not only equity, but also their fixed income portfolios.
And articulate why the ETF structure in this instance makes sense, because I think you must get that question of, actively managed fixed income mutual funds. We know how they behave. What's the disadvantage or relative advantages?
Well, so in general, active ETFs are going to be less expensive than even an active mutual fund. There's just more competition. It's easier to be able to have. The liquidity is stronger. So when you're buying and selling an active ETF, you're often you're trading on an exchange. You're getting the benefits of that liquidity, that transparency of price, unlike with a mutual fund. And you can really tap into the overall experience of ETFs. Even though you're buying bonds, you're getting a stock-like experience through ETFs.
Right. Jerome, I know that you've got some takes on this and exactly why maybe this type of approach makes sense in fixed income.
Yeah, I think one of the things to keep in mind, aside from all the systematic processes, is you're in an environment right now where we've moved from a dramatic shock in interest rates, a dramatic shot in risk premium, and it's ultimately translating into understanding the macroeconomic conditions that lay before us. What the active approach ultimately does is allows you to discern between those attributes where you have visibility, where you like risk, and those that don't. And right now, we're finding a preponderance of situations where caution probably abounds ever so more slightly than taking a little more risk into the portfolios. At PIMCO, we're ultimately saying that we want to be more conservative on the corporate credit side for sure. The starting point of spreads being tight is actually one arena that we would agree on. But then broaden out to see where the landscape, where there is also safe opportunities. Look to high quality asset-backed securities, agency mortgages, asset classes which have not only credit spread which can produce additional income, but do so in a safe manner by offering over-collateralization as well as assets underlying the actual securities as opposed to just unsecured corporate credit. And those things create differentiation within portfolios, especially if you should move into a more left tail scenario where the economy suffers perhaps a slight recession as we move further along into 2023. But ultimately, the active approach allows you to discern these risk factors, allows you to, within the fixed income market, find those opportunities and evolve them as more opportunities become clear, which we undoubtedly think is going to happen as we get later into this year and into 2024. The clarity from the Federal Reserve, more clarity from corporate earnings. Frankly, when we see liquidity conditions start to become better perhaps or more clear as quantitative tightening continues, these are factors which are a little bit unknown to the marketplace right now, create uncertainty for advisors and investors alike. And so the yield component of fixed income right now is something that we haven't seen for decades. And in doing so, creates opportunity not just to embrace the yield, but also earn some additional returns by being that active approach by differentiating between places where you should be more defensive and taking opportunities where you can take a little bit more risk, but do so in a constrained, safe manner. This is the exact environment where active management really holds its own.
Yeah, and not to mention, I guess, James, just the practical difficulty of perfectly replicating the asset class in fixed income, just the number of securities. And I mean, if you look at the index where you're benchmarked to, I assume it's pretty vast. There's constantly new issuance and things like that.
Yeah, and in the front end of the curve, especially where we
Yeah.
operate 5 years and shorter, it is difficult to replicate benchmarks. So active approach is certainly paramount, not only from the everything that Jerome just mentioned with regard to taking diversified risk, finding spaces where you see good relative value, but also it is difficult to replicate a benchmark in the front end when you think about a lot of bonds get bought and put away to maturity, and so you need that active approach in order to replicate the risk of a benchmark.